Hello, hello. Welcome everyone to another episode of Note Investing Made Easier. I'm your host, Martin Saenz, along with Shawn Muneio. Shawn, how are you doing today?
Oh man, I'm doing great, Martin. Did you see that video? That was exciting. I'm actually excited about that.
Yeah, just freshly produced and
Yeah.
absolutely good stuff. Well, before we get started with a very interesting topic, just have a few announcements. On November 6th and 7th, we have our next Note Investing Fundamentals Workshop in Las Vegas. So that's 11/6 and 11/7. You can sign up at noteinvestingmadeeasier.com. Also, too, Cashflow Dojo, which I just published in June of this year. It's building multiple streams of income in your life, is now out on Audible on Amazon. So there's a link on the Facebook page, and please check it out. Send me some comments, leave me some reviews. And before, without further ado, let's get it kicked off. I feel great. I'm, working my planner every day, and today I set as one of my goals to have fun. So that's what I intend to do. I'm typically a wound tight kind of guy. So I'm working on having more fun in my life. Do you have any goals you have set up for yourself?
No, Martin. But before we move on, we do have to wish you a happy birthday from yesterday. Congratulations on another year.
Thanks.
And so for fun, I'm looking forward to Vegas. That's some fun for sure.
Absolutely.
Looking forward to Vegas.
And I'm headed to Sarasota this weekend, so
Sure.
I'll kick off a little fun there. But yeah,
Nice.
all roads lead to Vegas, and we're gonna have another serious session. So I look forward to meeting the new group of folks.
Well, it's good to be here this week with the team in Virginia. Just another crazy week for us, as you know. Aren't they always crazy? But very productive week. It's always great to be here in Stafford with the team. So looking forward to the rest of the week. But yeah, fun is what we like to have. And don't forget to it's over here. Set goals and go. That's what we do here, Martin.
Very nice. Let's kick it. Let's kick it off here. We're going to talk about reperforming loans today. So let's first start off. What is a reperforming loan?
Reperforming loans are loans that have had a blip in their, pay history at some point in time, and an entity like Bequest Funds or another entity has bought those loans. Actually, Bequest just buys reperforming loans, but other entities buy those loans. They get them reperforming through some type of a modification that they may have completed with the borrower, getting them back on track. The borrower is making payments again, but there's that black mark on the history of the loan, right? And so that defines it in the industry as a reperforming loan. But yeah, there's an event that happened in the pay history which stopped the loan from paying. Somebody corrected it by modifying the terms or extending the terms, whatever had to happen. But there's a black mark on the history, but they're still great loans.
Yeah, so typically reperforming loans, are loans where the borrower's paying again, and it's within a 12-month period that the borrower has resumed making payments. So typically, the industry deems that loan to be a performing loan, so moving from reperforming to a performing state after 12 months of seasoned on-time payments. So that's kind of like just a little, technical jargon. But basically, it's a borrower, that's back on track. They're paying, and we're going to talk about what makes a good RPL and versus a bad RPL. And let's first, before we talk about the RPL note itself, and what you look for. Let's first talk about the business or the individual that's buying these loans, right? So how does using their own capital versus cost of capital come into the equation?
So if your business that you're setting up for yourself is to invest in reperforming loans, if that's your goal, and so you're out searching for reperforming loans to pull into your own portfolio, there's a couple things you gotta take into account. The first thing is your cost of capital, right? You could be borrowing capital to build this portfolio, or you could be using your own capital. And so when you decide to get into the business, you do have to understand what are my objectives? What type of returns am I trying to obtain with buying these types of assets? And so that's a good place to start, right? Understand your goals when you are in fact investing in reperforming loans, and there's many different types of reperforming loans that you can buy, firsts or seconds, but you need to understand what your target is. What do you want this portfolio to do, and going into it assuming you can get a 15 to 20% return is not realistic. But defining a goal and then understanding what your cost of capital is. If it's your own money, your cost of capital are clearly opportunity costs. Where else could you put the money, right? If you're in fact borrowing money or using investor capital, you've got your cost of capital, and so that's where you need to start, right? What are my goals? What are the resources I have to deploy? Is there a spread? If I'm going to build a business around this for myself, the work that I'm doing in running due diligence and buying these assets and monitoring them, I need to be paid as an operator for that work. And so, you need to understand what that spread is too.
What's interesting is you see a lot of individuals, they operate in this space and they just look at the dollars and cents of the transaction. But what's so critical to note is having an operation in place by which you can handle default, right? So these loans come at a high yield. And so do they just come at a high yield and they're just magically, really good investments to make? Or is there some additional risk associated to these reperforming loans that you have to account for from an operational standpoint? You want to talk about that?
Yeah, absolutely. So the high yield comes with risk. There's no question about it. And if you're going to get into buying reperforming loans, whether with your own capital or investor capital or even IRA funds, the reason the yields are so high is because there's risk. And to assume that if you buy a portfolio of loans and nothing is ever going to default, you're not preparing yourselves to be a true operator of these types of assets. And so the reason these yields are so high are because that risk is there. And so as an operator, because that's what you're building a portfolio, you are going to operate it. You need to understand that in fact these loans will default. It's not when, but some will default. And what is your plan of action around default? You need to have one.
So plan of action for default. Looking at worst case scenario. And it all starts with using the PEEPs, right? Monitoring. So monitoring on a daily basis entails what?
Well, here at Bequest Funds, our team is every asset manager is responsible for reperforming loans. And so their job every day, they come in and make sure they know when the next payment is due. They can read the servicing notes to see if, in fact, there's been any communication with the borrower before the payment's due. If the past due date comes and goes, They're watching to see if communication happened with the borrower, and just keeping an eye on it. They're responsible for making sure all of the RPLs pay on time that are in their queue, right? So just monitoring performance is key. You need to know on a daily basis who's paying and who's not. I mean, that just goes with the fundamentals.
Yeah. So, and then there's a whole tracking process to it, whereby you have, I think tolerance is the word that comes to mind. So what are you willing to tolerate if a reperforming loan, if the borrower on the reperforming loan fails to make their payment within the due date, fails to make the payment from the due date to day 30, fails to make the payment from day 30 to day 90, and then beyond day 90. So understanding, having a plan of attack for addressing defaults on the reperforming status as they hit each stage of default is critically important.
Absolutely.
So how does the partnership with your servicer come into play?
Yeah, I was just going to say that part is critical. Obviously, all the loans that we own are serviced by a licensed servicer, so we're not servicing the debt. Licensed servicer is, but understanding what your responsibilities are as an owner operator of the assets in the event of default is where it begins. If you're going to get into buying reperforming loans, you need to have a servicer. There's no question about it. But more importantly, you need to understand the servicer that you do pick. You need to understand where their responsibilities end and where yours begin as an owner. And some servicers, you can leave the entire default process too, right? And that's an expensive option. But if you, as an operator, don't want to deal with it, you can in fact have your servicer handle everything. Now, we like to build relationships with our borrowers, and so if a default happens on a loan, we like to take over and start handling the default. We like to have control over that. We like to build relationship with the borrower. We like to understand what's going on with the borrower so that we can help them if need be. And so we like to build relationships with our borrowers. We recommend building relationships with your borrowers, but if that's not part of your operating model, then in fact you can leave that entirely up to the servicer.
Yeah, you can go with a full loss mitigation program, whereas the servicer will move it from a standard servicing program when it's reperforming into a full loss mitigation program where they'll have all the contact with the borrowers upon the event that it's defaulted. We have a question from Cindy. As an owner operator, do I need to be licensed?
Yeah, that's a very interesting question, and one that we've been dealing with a lot here recently. And I would just say it depends on the state, right? Every state has their own requirements. Every state looks at you as an owner operator a little bit differently. And so understanding what states you're buying in and whether or not you need an MLO license is very important, a step to make before you in fact begin to buy reperforming loans. But yes, there's some states that we're required to be licensed in, even just to own the debt as a debt owner or operator. So yeah, you need to check with your attorney or attorneys in general and understand what the requirements are in that particular state.
Yeah, that's it. Before you buy the loan, check with your attorney to see if there's any licensing to own that asset, whether it's in a performing or non-performing state, and that'll help safeguard you against any issues civilly or what have you down the road. So very, very, very important. We've even seen where we've had our loans performing, and a borrower may catch wind of something. And we had one in Maryland where they wrote the attorney general, and they're like, "Oh, these guys aren't registered." After they've been paying for a year, they just out of the blue wrote the attorney general, and we got with our attorney and said, "Hey, we got this correspondence." Our attorney said, "Nope, you guys are fully covered. You guys are good to go. It's we'll deal with that as it comes, as the attorney general corresponds with our attorney. And, it's just going to be a legal bill that we add on or send to our servicer to be added onto their account. So, it's just one of those things. Well, let's jump into an RPL that you're looking to buy. So let's start first with the importance of valuing the collateral.
Absolutely. When you're buying a reperforming loan, you need to understand the collateral that's backing that promise to pay. If a borrower does not pay, defaults, you as an owner operator, you obviously can take back the collateral through a foreclosure process. And so understanding what that collateral is worth before you buy the asset is critical. So most of the time it's a single family residence. And so, getting a BPO or using some type of AVM to establish a value is step number one.
Yeah, exactly. So let's go into, obviously you have a promissory note, and then you have a you have a mortgage, right? Or deed of trust. So you have that ties that promise to the property. So, so that's a security instrument. So you're dealing with the property, which is the collateral you're talking about, and you're dealing with the borrower. So what type of risk factors do you look at when you're looking at the borrower?
So when we look in a reperforming loan, we're looking to purchase it, we pull credit, right? We need to understand the FICO scores for the borrower. We need to understand their debt to income ratios, and so we can do that with credit reporting. If you don't have the ability to pull credit, then request it from the seller. Request the latest credit report from whoever's selling the asset. But understanding the borrower's financial situation before you get into buying the promise is a critical piece. And so we like to see credit scores in the 600s if possible. We also like to see the debt to income ratios on the lower end. But these are really important characteristics that we're looking at in order to try and understand if the borrower is in fact going to maintain their promise. We also look at history, right? History is a very important step as to looking at the patterns, and we kind of touched on, we started with tolerance. Like what is your tolerance for a borrower when they stop paying? And I would say our tolerance is set by the history of the loan, right? As we look at the pay history, and we see that the borrower always pays on the 14th day, when in fact the loan just goes late on day 15. If in fact the borrower always consistently makes their payment on the 14th, I'm not going to be worried if the due date comes and goes, because the history has told me when in fact that borrower consistently pays. And a lot of servicers will tell you, they'll actually score the history and tell you if this borrower is 1 or 2 days before or after what they've normally paid in the past. And so there's a way to kind of assess, if they're just 1 or 2 days before or after the day they normally pay every other month, like, I'm not worried as an owner operator. I'm not worried. But when I start seeing those numbers change, like the borrower's always 1 to 2 days late, and then all of a sudden now they're 20 days late, right? I'm starting to worry that something's going on, and so that's when our asset managers know to reach out and have a conversation. But the pay history is a critical piece to understanding what is going to happen in the future. Obviously, you're projecting, you're making some projections about a borrower, right? If you see the fact that they're always 1 to 2 months late, and they kind of roll that through, then you need to expect that. If you buy that asset, you need to expect that, hey, this borrower has gone 60 days late in the past, but has brought it current. They kind of have this pattern. If I look at the past 2 years, and so that history tells a story, you need to understand it.
Yeah, and your bid price needs to reflect it. So like you're saying, hey, the borrower missed a payment in the last 12 months. Well, are you going to place a bid on that asset? Let's say that you still want to go through and buy it. You're going to place a bid on that asset as if they've made 12 months of payments? Or are you going to place a bid on that asset as if they made 11? What does 11 payments, roll up to on an annualized basis? And you're going to want to price it based on the reality, and they may, and that's the 11 payments. So the yield offering will be much higher in that case. Let's jump to mod structures. So modification structure. So how important is it that, how important is the loan modification structure to the strength of the RPL?
The loan modification structure is a critical piece to understanding the new terms that have been set up, how long they've been in place, and what the commitment was before the borrower got into the modification. We see a lot of modifications whereby the owner of the prior note who did the modification did not require the borrower to come to the table with very much money at all. And a lot of the times we see those modifications fall apart because there was no real skin in the game from the borrower. They stopped making payments. Luckily, their loan was owned by an operator, an owner who didn't require them to put a significant amount down to bring the loan current, and therefore they think, well, I can just do this again, no big deal. The operator will take whatever and make me current again. So if I get behind, I'll just do exactly what I did before.
So also too, we see modification structures where the lender is not fully amortizing the loan. That's unacceptable, or they're trying to balloon it out to get cashed out too quick. And we're looking for a legacy play for long-term streams of income. We're not looking to force someone's hand to refi us out. We've seen modifications where they're only 1 page in length and they're not even notarized, and so they're really ambiguous. We've seen modifications where someone owes, $70,000, $90,000, and the lender's only taking $100 a month payment. So, i.e., that loan matures in infinity, and so how well put together that loan modification is tells a lot about the quality of that lender's operation, as well as the strength of that relationship between the lender and the borrower, and the probability that you're going to get repaid as you need to. So performance of cash flow, let's kind of talk. I think we kind of touched on that in terms of looking at the pay history and understanding the likelihood that you're going to get paid, but you're also looking at some other metrics, right? I mean, the probability that there's going to be fallout, right? Probability that they're going to refi you out, and those kinds of factors. How do they come into play?
So when you're calculating your cash on cash returns, understanding that there's a risk for default must be taken into account. And so when you're calculating the yield, obviously you're going to pay a discount against the principal balance. That discount is going to create a yield for your investment. You need to take into account the fact that there's a default risk here, and so you need to discount the yield based on the potential risk that you've placed on the asset, and so you need to calculate kind of a risk assessment as part of your calculation.
Yeah, and what's interesting is just through this whole discussion, everything seemed to be focused back on a non-performing loan. And so what we haven't stated is that we'll look at the RPL with its pay history, with servicing comments to understand, what correspondence has gone on between the borrower and the lender/servicer. But we will also take that RPL through the same rigorous process as if it was an NPL from a lien validity standpoint, from a Pacer, bankruptcy search, from Realty Track, from all these other tools that we use by which we perform due diligence on non-performing loans. So in many cases, RPLs is a more in-depth process from a due diligence standpoint. And so it should be treated as such, because you should always be prepared and planning for having to do maintenance on that note at some point.
Absolutely. And if you just think about what RPLs sell for in the marketplace, and then you think about what an NPL sells for in the marketplace, an RPL can turn into an NPL fairly quickly. And so that risk associated with that devaluation of the asset needs to be considered as part of your risk factor when buying it.
So you don't want to just look at, hey, I created forced depreciation, right? I moved this asset from a 30 cent on the dollar value to 85 cents on the dollar, but you have no you have no game plan in place for that asset moving from 85 cents back to 30 cents.
As a RPL investor myself, understanding how to deal with the asset as an NPL is a tool that you need to have in your toolbox. If you don't have that in your toolbox and you're venturing out into the RPL space, you're just asking for trouble. And putting your money or your investors' money or your IRA dollars at risk. You need to understand the NPL process if, in fact, you're going to operate a fund where you buy reperforming loans.
That's so well put. Well, I tell you, great discussion, Shawn. And, we have a whole host of videos. We have over 90 videos on our YouTube channel. So please subscribe to us at Note Investing Made Easier on YouTube. Subscribe to our channel. We have about 2,400 subscribers. Yep. So lots of activity on that channel. And we thank everyone for their time today. And we wish you all a happy and prosperous week. Take care.
See ya.